So hello everyone, thanks for joining today. I'm Henry Barrowclough, otherwise known as Henry in Hosted by Henry. I'm the Chief Revenue Officer at Bakering, and we've had a huge response to this new series which we're launching today, as well as our Global Outlook economic reports. So as a reminder, please register at hostedbyhenry.global if you haven't already. And at the end of this, as at the end of the session, we'll be sending out a summary of the Global Outlook report, along with access to our entire library, white papers, economic reports, and fact sheets. So how we're going to run this today, this afternoon, is we'll be looking at the economic data with our economists, Dyrcz and Robert, and then we're going to look at the data available in each region. Sorry, stuttering there. And then Tim Wendholt of Corporate CPR will follow that up for us. And then we're going to have some of our panel industry experts giving us their views on the biggest challenges in the region, Eastern Europe, and what mitigation strategies we could look at. So at the end of that, we're going to do some questions and answers. So please submit your questions whilst people are presenting. And then hopefully at the end of the presentation, when we get through that, we'll have a bit of time for people to hold on, I've got to move this other screen now. So a bit of time to people to answer some questions for you. So we're going to keep this at quite a fast pace today. So please, if you can, pay attention, as we've got quite a lot of stuff to fit in this afternoon. So I'm going to have to skip Lisa's introduction, who's our CEO at Bakering. Sorry about that, Lisa, and skip straight into Dyrcz, one of our economists. So Dyrcz, if you're there, could you please kick off with your part, and I will start your slide for you.
Sure. Thank you, Henry. Hi, everyone. My name is Dyrcz Semi. I'm an economist with Bakering, working on the Global Outlook series. So obviously everyone has access to the full report and can really go through the detail in that as and when needed. But I just wanted today to highlight some of the key points which I think characterize the situation in the region moving forward. So Henry, if we could turn to the first slide, please. Brilliant, thank you. So the first point I'd like to make is that the COVID-19 crisis has hit this region particularly hard. Currently, 7 out of 20 of the countries most affected by COVID-19 worldwide are in Eastern Europe, and they're marked there on the chart on the slide. Now, this is due to a number of vulnerabilities which have left the region particularly exposed to the health and economic impacts of the pandemic. One key vulnerability stems from years of underinvestment in healthcare systems, which has left them overburdened and unable to cope with a health emergency on this scale. On the economic front, a high dependence on exports and tourism revenues, as well as limited government capacity to finance rescue packages, has meant that lockdowns both domestically and abroad have hit the region very hard. Turning to the second slide, if we may, Henry. So on the positive front, the regional economy is now slowly recovering. GDP should rebound by around 4.3% on average across the region this year, after contracting by roughly 3.2% in 2020. But risks to this projection are very much to the downside at the moment, given that there's still a high degree of uncertainty over the course of the pandemic, and of course then the associated restrictions, and business and consumer confidence remain very fragile amid all this uncertainty, and unemployment still very much rising in some countries. If we could turn to slide 3, please, Henry. I think another key thing just to be aware of is vaccine rollout in the region, and how that's probably actually one of the biggest risks to these GDP projections going forward. So we actually expect that vaccine rollout in the region will lag behind that of most other key global regions. And as I said, this is actually one of the main risks to the recovery. While a number of countries in the region have actually commenced their vaccine programs, most notably Russia, has developed its own vaccine, Sputnik V, there are many issues with securing sufficient supplies in many states, infrastructural and logistical constraints, as well as vaccine skepticism. On the infrastructural side, many of these countries are very vast. They have to get across mountainous regions to populations who live in very remote areas. And overall, we expect that vaccines won't be widely available in most countries in the region until late 2021 at the earliest. And indeed, vaccine skepticism really does remain a challenge in the region, particularly in the ex-Soviet countries, where attitudes towards vaccination have been shaped, at least to some extent, by a lot of negative healthcare experiences during the communist period. And in fact, as you can see at the bottom on the slide there, recent data actually shows that in Kazakhstan, just 25% of citizens say they would opt to be vaccinated against COVID-19, compared with 75% of Brits and 56% of Americans. Turning to slide 4, please, Henry. Thank you. So overall, financial conditions in the region remain very tough, despite the gradually and tentatively improving economic backdrop, and credit risks are still elevated. As I said before, unemployment remains high and is in fact still rising in some countries, and businesses continue to contend with obviously very subdued demand. Moreover, as you can see on the slide there, many regional currencies have come under pressure amid the crisis and have continued to depreciate in recent months as investors have flocked to safe haven assets. Now, this has obviously particularly put pressure on consumers and firms with high levels of foreign currency denominated debt. Turning to slide 5, finally. So this is just giving an idea of the inflation picture. Inflation slowed sharply in 2020 and is expected to remain subdued in 2021 amid the still muted economic backdrop. Now, while this should, in theory, help to bolster consumer spending, practically household budgets are going to remain stretched as labour market conditions continue to be tough, uncertainty is still elevated, and many government support schemes, while still in place, are largely due to be rolled back this year as governments now look to fix their fiscal positions. Therefore, household consumption is unlikely to recover fully this year, with a more convincing pickup in spending likely to kick in 2022. So that's it from me. As I said, that's just really a summary of the most important factors, and I'd certainly recommend downloading the full report if you haven't already, as obviously, depending on your trading circumstances, some of the detail might be very important to you. That said, I'm now going to ask Robert Dyrcz, head of the Polish Institute of Credit Management, to take over with a brief drill down on the region's most important market, Poland. Over to you, Robert.
Thank you, Jess. Thank you. Good afternoon, everyone. I dare to add something more to this presentation regarding Poland, maybe a little bit about the region. But first, let me start with some remarks regarding the pandemic itself now. I agree the situation is not so optimistic, I would say. Beginning of next week, we have again more restrictions in Poland, and the infection rate is going significantly up. So this is something for sure we should look at, taking into account overall economic conditions, not only GDP, inflation, and unemployment. So the situation in Poland is worsening now. So we have third wave of pandemic, and it's similar to what we experienced last year in autumn. Maybe one just remark to the exchange rate of PLN. You saw on the previous slide that our currency is depreciating or depreciated significantly in the last months. I think it's important to know that part, at least, of this event was caused by action from our central bank, who is selling actually PLN, trying to support the exporters. Poland is a pretty big exporter, and this is helping a lot of our economy. We will see this also on this. We see that on this slide when we look at balance of trade or balance of our current accounts in the last month. But first, just a short remark about the graph on the left top side. This is a so-called sentiment survey among Polish entrepreneurs. For the last couple of years, we see big drop for the spring last year, and gradually the business confidence is growing up. I don't know how much you know about the methodology of this of such a surveys of such indicators. They are based on surveys among entrepreneurs in different economy sectors. Here we have a split between manufacturing, construction, retail trade, and services. Of course, services are suffering the most, and here we see still a lot of issues. So if you have a customers there, be careful. On the contrary, the manufacturing and industrial production overall is doing very, very well in Poland, and the business sentiment there is much, much higher than in other sectors. Okay, if we can go to the next slide, another indicator which I would like you to pay attention at is so-called Purchasing Managers Index, PMI. It's global survey of business sentiments. The previous one I showed you was the local one done by the Polish Statistical Office, and this one PMI is done globally. For Poland, we have only for manufacturing. Normally for other countries we have for services and for manufacturing. In Poland we have only for manufacturing. So we see here that the business tendency is pretty well. So it's on the level we can say like before the pandemic. Some economists are saying that we have K-shaped recovery when industrial production is doing very, very well, as people are buying stuffs and they spend money for that and cannot spend from the other side on services like going to the restaurants and so on. That's why I put also on this slide the data regarding Polish industrial production and construction output. I think Poland is one of the leader now in Europe in terms of dynamic of industrial production. And if we could go to the next slide, I believe we have there, we have here a comparison to other countries in the region. So I picked Czechia, previously Czech Republic, actually now we should call them Czechia, Romania, Hungary, and Ukraine. When in terms of manufacturing, they are still struggling, while Poland for the last couple of months is doing very, very well. And if we could go to the next slide, please, we should have there, exactly the comparison for all European Union countries, and Poland is on the third place in terms of production dynamic, and this is comparison year to year from the January. So it's very well, we can say. I don't have here anything about the unemployment, but maybe it's good to know that unemployment in Poland is on the historical low levels. And I think for January or for February, it was the lowest in Europe. And all of that is obviously due to a lot of cash injections and other support given by the Polish government. which amounts close to 6% of GDP. So it was really strong support, especially at the beginning of pandemic. And now with the second and third wave, entrepreneurs are facing more issues. Just selected economy branches are supported, not all of them. And we see that in increasing insolvencies, especially in sectors like hotels, restaurants. They unfortunately don't have such a big support from the government like before. Okay, and if we could go to the next slide. Here I put some graphs regarding not entrepreneurs but consumer sides. So again, on the left top you see the similar survey of consumer confidence. It's not so good like for the business confidence, I would say. Although unemployment is on the low level, people are afraid of being laid off in the months to come. And in that way, we should explain why still this overall confidence regarding economy, regarding the personal financial situation and the perspective for the near future is relatively on the low level. We see that in the, let's say, hard data. That's why I put on the right top of the slide graphs showing retail sales comparison year to year, and we see that there a drop in the sales. As I said, we have another lockdown of shopping malls and so on. So all the retailers which are not online, they are suffering a lot. In general, of course, the online sales is going rapidly up, but I think Poles like to buy traditionally. So that's why we have this drop in the retail sales. And comparison to Bulgaria, for instance, and Czechia, it's not looking so bad, but still, it's the consumption in Poland is a very important engine of the economy. That's for sure. That's why we should look at it very carefully. Okay. If you have any questions, please do ask them. If we could go to the next slide. Here I put something around inflation. I think it's the main risk this year. The fact is that Polish National Bank, as you probably know, we are not in euro area, so we have still our own currency. We are emerging market, and we should normally, and this was in the past, avoid any money printing or quantitative easing. But this time, similarly to many other emerging markets, our bank is doing a huge quantitative easing program. So literally is buying the governmental bonds, not directly, but through commercial banks. And overall liquidity situation is very, very positive, I must say. And this is confirmed by what factoring companies are saying. And in general, this is the feedback from the market. There is a lot of liquidity, but this liquidity is not yet unleashed, I would say. And that's why I put on the top the two graphs from the 2 years of this crisis and the last crisis. So we have completely different situation now. Deposits are skyrocketing, we can say. There is a lot of money everywhere, but this money is not yet fluctuating, and that's why still the inflation is on the low level. But once people will be more confident, so this previously shown consumer confidence will go up, I believe that this money will start to fluctuate and accelerate the inflation. And we see this already in the inflation statistics, but still it's, let's say, on the relatively low level. And of course, it's artificially held by the low interest rates of our central bank, and we don't expect they will increase the rates unless they will be, let's say, forced to do that by accelerating inflation, which starting somehow now. So this is very, I think, important risk, because cost of the money, if the cost of the money will increase, taking into account the relatively teeny margins of Polish companies, which is a problem. I don't have the time to speak more about that now. The cost of financing will eat those teeny margins. So, of course, it's a very, very general look, right? But this is the
Robert,
risk for sure.
Can we move on to the PICM data, please?
Yes, of course.
Can we talk about that?
Yeah.
Thanks.
Yeah, so we have a lot of data, and of course we need to, as a credit managers, look forward and try to assess what are the risks for insolvencies of sector of specific economy sectors. That's why we developed in PICM so-called PICM risk index, and all PICM members have access to that. This is based on business tendency surveys published by Polish Statistical Office. And it has its own methodology and calculation. And at the end, the index fluctuates between 0 and 100, when index above 50 should be read like the important risk in the sector. So here you have the example of overall manufacturing risk index, which is on the historical high level, is around 70, so should be considered as a moderate risk, or a little bit even more. And if we could go to the next slide, please, we also calculate the same index for other countries in Europe. So you can see that the insolvency risk for Poland is the highest in Europe. Right? Maybe not on the highest level, but compared to other countries, it's very high. So this is the conclusion from this calculation. Of course, it's inside manufacturing. You have a lot of different subsectors and with different level of risk, but this is general estimation for the risk overall in the industrial production. Okay, I think this is the last slide. I don't know. I managed to do that in 10 minutes.
No, you didn't. That's all right. Don't worry, mate.
Okay.
Okay.
Thank you.
No worries. So thanks a lot, Robert. Thank you, Jazz. That's a very valuable summary of the data. And I think it gives us a better understanding of the situation and now what the figures also mean for us. So what I'd like to do now is get one of our panel industry experts in a moment to see what the biggest challenges are from them. But firstly, briefly, I'd just like to bring in Tim Wendholt from corporate CPR for some more perspective on this credit data availability in this region. And again, I see there's quite a few people now on the call. So if you do have any questions, please send me the questions on the chat and we can cover those off at the end. So over to you, Tim.
Thanks, Henry. You've heard the big brains. Now I'm afraid it's down market to me. What we'll be doing in the next, what I guess will be 10 minutes, is trying to put a little bit more of a practical spin on how credit folk can actually make decisions based on the, relatively speaking, sparse information that's available in the region that we're discussing this afternoon. And that, of course, is against the context of the macro data that we've been looking at since the start of the call. I obviously don't know who is the audience here, but I'm assuming most folk are involved in credit management in some way, shape or form. Therefore, there's a knowledge out there about how data might be made available. The business that I'm working with is very much in the area of credit data, and that means in this particular scenario, that data which might be available from a credit agency. I won't go through the brands that we might be talking about, but that's essentially the market where folk will at least go for an initial look-see. So what I'm going to do is put a little bit more meat around the available data. The general concept is that the data is just not readily available. Well, the answer sometimes is actually it's just not available outside of the country or outside of the region, which comes back to the way that users might consume that data. And that might be where the issue is as much as anywhere. Having said that, I've categorized the markets, as you can see on the screen currently, into the normal countries you'd expect, and I've just selected 4 very basic items that are available quite commonly in the country that we're looking at. Now, of course, folk will automatically want to look at a reasonable level of financial information if they can. So you can see from here that it's actually quite readily available, with the exception of if you were to bet on it, Armenia, Azerbaijan, the stands in general, and Kosovo, which is a burgeoning state, shall we say. But Poland, Russia, the Baltics all have readily available financial information. The trick is accessing it. Now, for many a year, clients have asked me about those regions and whether, for example, it's possible to monitor risk in those areas. Well, if you're within the region, the answer is probably yeah, because you can now buy data, or access data, I should say, in XML from the registries in Russia, Poland, Estonia, Latvia, Lithuania, and a couple of others. However, for that link to the XML data to be made available to a desktop in London, for example, is a little trickier, because there has to be a certain amount of pipe work put between the consumer of that data and the source of the data. And for larger credit agencies to make that pipe work readily available is expensive for them, and probably not enough critical mass to make it a viable commercial option. It will come as the cost of doing that comes down, and the markets pick up again post-COVID, as inevitably they will. But right now, if folk are relying upon standard reporting processes to acquire that data, then you may find it disappointing by comparison with some other markets, even now. What I've done a very brief and basic assessment of the red, amber, green classic way of determining how good or bad a country might be. Not the whole lot. We're not going to walk through that entire list, but just to give you a flavour, the red cases are the ones we've talked about, but added in Belarus, Georgia, Armenia, Azerbaijan, where it's almost impossible to get anything other than very basic registry type data. I've categorized Russia, Ukraine, Moldova as ambers because it's available but difficult to get and not entirely consistent. And then the green cases, well, Poland's got a lot of good PR today, and they are top of the list in terms of available data. Plus Czechia, I've now learned to call it Czechia, not the Czech Republic. Slovakia, Slovenia, Latvia, Lithuania are all good areas, and ones which can be relied upon relatively well. Now, again, assuming that your standard means of accessing this data are via traditional credit reporting processes, which hopefully, as experienced credit managers, you'd be able to embellish with input from credit insurers or local representation. But starting point being a good old-fashioned credit report, there are certain aspects of it which I've tried to turn into an egg-sucking process here, which is simply to help you get a level of expectation of what might be in a report and therefore how you might want to categorize it. It's going to vary from person to person, from company to company, depending upon their appetites for risk and their levels of profitability, all the usual measures. But I've created a little table here based on what I can get from a credit report. Clearly, it will vary again as the company is bigger and makes more available information as well as having history. But it is readily available and enables a very, very fundamental or rudimentary, would be a better word, matrix to be created. And it does work from the fact that many companies will have little or no information. If I may, we talked about Poland a lot, but Russia is one I'm often asked about. And there are 11 million company records on the registry in Russia, but of whom only 1.9-ish million have any financial content. So yeah, it's clearly going to help you put that type of availability into the context of this little matrix that I've created here. I should just add, by the way, that in that same registry, there are 300,000 companies in liquidation. So that kind of gives you a flavor for that. So there are things, not all great in the areas, as you might gather. Can I go on to the next slide, please, Henry? Okay, continuing the matrix theme and touching on the lack of availability of financials in many areas. This again, by the way, are made up numbers, made up weightings, but just to give an idea of how, based on a fairly classic credit type report, whilst they might have their own risk assessments in there, that they are very generic, clearly, and don't necessarily relate to the way that an experienced credit manager might assess risk. But it gives you an idea of how, based on the data that might be available to you in a report, that you could actually put together some kind of method of sifting out the good from the bad, or the good from the less bad, shall we say. So those with financials, those without financials but a parent company, those without any financials whatsoever, which, as you'll have heard in Russia just now, is the dominant area. And then, of course, the offshore factor. We talked about Russia, so clearly there's an element of offshoring as well. The risk percentages in here are, as I say, made up, but they would represent your view of importance in making your own risk assessments and should mirror how you might do an ordinary UK-based or French-based risk assessment. One area I've found quite weak in the local registries is the area of determining actual shareholders and therefore ultimate business ownership. It's an area I'm constantly challenging and having to look a little bit more closely to determine whether there is or isn't a valid and operationally important parent company. If there is, then clearly that changes the risk perspective, and then you're looking at how they operate within the regime of the particular country that you have some risk. But from taking this very, very basic matrix report, it will at least give people the option and hopefully the knowledge to come up with a basic way of assessing whether or not it's worth perceiving a relationship with any particular counterparty. Now, I'm conscious that I'm now already over my 10-minute slot. I have a lot more information which we chose not to put on screen because it would have induced, but it is available. And if anybody would like to ask questions about it, provide a whole load more matrix about data content, company records, type of records, etc. in those markets in the slide that we looked at initially with each country nominated. So Henry, I've rushed and not too confusing for folk. And now over to Ian, I guess.
Yeah, thanks a lot for that, Tim. That was perfect. I think we're getting a good background sketched out now on what's happening and how we can keep track of developments. But I'd like to bring this to life by getting one of our panel involved. So as we've already seen, Ian, would you like to expand on what your experience on the ground, and give us an idea of what the biggest challenges are in the region moving forward, please?
Yeah, sure. Thanks, Henry. And hello, everybody. Obviously, you can see my name there. I'm Ian Leslie, Head of Business Development at Aon in their Credit Solutions team. So obviously, everything that we're talking about today is pride place with me and something that I see on a daily basis. You can just flick to the first slide, please, Henry. In terms of the last year, obviously it's been difficult for many people, both on a business level and on a personal level. But in terms of when the pandemic first started, and probably a consistent thing throughout the entire year, is there were so many comparisons made between 2020 and kind of 2008, so the pandemic and the financial crisis. In reality, and I'll go on to in a minute where the differences were from an insurance perspective, but in terms of the actual economic impact, they were completely different. I mean, how obviously they started was completely different in terms of the slow start and the fact when the virus began to spread, each country then had its own economic impact at a different point in time, rather than there being almost like a big bang scenario as there was with 2008. The length of impact has been massive. I mean, obviously we're all still sat on a virtual webinar a year later for some people, including myself. You've been working from home or working on an agile basis for a long period of time. So the length that this has gone on for now has been considerably long in comparison. But also, and finally, the way in which it's been handled by the respective governments. There has been stimulus schemes that have been put in place, and also we've seen from an insurance perspective, there government schemes put in place which have enabled the insurers to have a lot more clarity and to be fair, protection that they didn't have back in 2008. I'd like to flick on, please, Henry. Thanks. So in terms of 2008, the insurance market reaction was one really of limit withdrawals and limit cuts, and anybody that was credit insuring back in 2008 probably doesn't want me to bring it up because it'll open some old wounds. But it was one of mass sector exits. It was extremely fast paced because, as I said, there was that kind of big bang approach to it, and the insurers were having to make decisions with very little lead time and very little time to analyze where they were at. It was a very difficult position for them, which then obviously the knock-on effect of that is it becomes a very difficult position for anybody who's using it. And in short notice, I wasn't at Aon at the time, but I know from talking to colleagues that they would be coming in on a Monday morning to, and this was back in the days when you used to print everything off, reams of paper of limit withdrawals, the stacks of limit cuts that they were having to notify clients about. So everything was very fast paced with very short notice periods. If we then compare that, and the next slide, please, Henry, to what we've seen this time round, it's a completely different picture. And you could argue that that's lessons learned from 2008, and that the insurers now, thanks in some way to the financial crisis, knew what to expect this time round. But I think the probably more realistic answer as to why it was different is because the way in which the pandemic's kind of gone on over the last year. So the government stimulus schemes that were put in place and there are people far more intelligent than me that can talk about some of those. But the fact that we haven't seen that mass insolvency hit that what was expected because of these stimulus schemes, the protection schemes that were put in place for the insurers themselves, so enabling them to continue to write cover throughout the pandemic. They differ between regions, but generally, certainly in the EU and the UK, that most countries are covered by them, and that's enabled insurers to retain a really good level of cover throughout the pandemic. And I'll show some graphs in a minute as to how that's been from an Eastern European outlook. But those three things themselves are things that are massively different from 2008. I know that there was an attempt to try and put in a similar scheme back in 2008, which was there to protect the insurers, but it just didn't work, and it left them in a very vulnerable position, which then obviously impacted on clients. Next slide, please, Henry. So when this first started, the fear was that we were going to see Armageddon in terms of insolvencies, that without trade, the businesses would just collapse, and we would see entire sectors, just completely obliterated. Obviously, that hasn't happened. I don't want to say that hasn't happened at all, because I think it would be a brave person to say that that's not going to happen. Once the stimuluses begin to ease, but we certainly haven't seen that. And what that's led to, from a credit insurance perspective, is a massive drop off in terms of claims. I mean, across Eastern Europe, we've seen an average claim fall by 11%, and that's across all the kind of main insurers in that area. With Slovakia, Lithuania, and Latvia seeing falls of over 20% in claims, and that's against 2019, both those numbers. The forecast then for 2021 and 2022 is to expect that number to rise, and that's not rising in terms of against 2020, but rise actually against 2019. So the insurance market's expecting a 17% rise in 2021 against 2019, with then a 31% rise against 2019 and 2022, and that all leads into the thought that Armageddon, if you will, hasn't been averted, it's just been postponed. And rather than it happening in 2020, which is what a lot of people thought at the beginning, is that it became kind of Q2, Q3, Q4. Now we've got the economic outlook is pushed into the back end of 2021 into 2022, when we're expecting to see a higher level of insolvencies. Next slide, please, Henry. Obviously, I mentioned around coverage, and I think it's really important to highlight this, because sometimes credit insurance, and going back to 2008, this unfortunately is a culture they created themselves, but was that the insurance market can hand you the umbrella, but the second it starts to rain, takes it away. So that hasn't been the case over the last year, and that's really good to see, for no other reason other than we know that people use this product not obviously for information, but there for protection, and the more stable that protection is, the better it is obviously for the end client. So this graph on the left hand side, which hopefully everybody can read, this is powered by Aon's internal data analytics. So we get information from the top carriers, which we pulled together to show you this graph here. But what it shows is that throughout the term, so March 2020 to March 2021, across the countries that are within the report, we saw an average approval ratio of 60%, which, to be fair, isn't too different from what we would have seen for the same time period a year before. Give or take, it's about 2 or 3% less, but nowhere near the sort of drop-off that we saw in 2008. And in fact, the first 3 months of 2021 had a 68% approval rating. So of all the limits that were requested within those periods, all the credit limits, 68% of those were approved by the insurers. The other bit to add on to this is around the higher risk buyers. So anybody who uses credit insurance should be aware they grade them same way that credit managers will grade. And actually on the higher risk buyers, that's buyers graded in the kind of third and fourth quartiles, we saw 61% approval rating, which again shows that consistency of cover, which has enabled people, certainly over the last 12 months, to continue to trade with confidence, which is really, really important. Final slide, I think, please, Emma. Cool. So as we look towards 2021, and I know obviously we're already in it now, but for a lot of countries and a lot of areas, it probably doesn't feel like it's changed a great deal from 2020. But as we begin to get out of lockdowns and things begin to get back to some level of normality, businesses shifts will change from from originally resilience and then recovery into growth. And there's a couple of factors and a couple of, I guess, challenges that certainly Eastern European countries face, the companies within those. One is further disruption. We've already seen. I was going to call them the Czech Republic, so apologies for that. But Chechnya, we've seen that in terms of the reinvigorated lockdowns there, and whilst they are hoping to ease soon, I think the term has been used, they're almost their own worst enemy because they managed to handle the first wave so well. They've almost been hit worse by the second wave because they eased too quickly. There's the information gap. So as Tim was mentioning, whilst there is plenty of companies out there that provide financials, the access to them is difficult. And I would certainly still say that one of the key benefits of utilizing credit insurance, other than the obvious one around the protection piece, is actually the information the insurers have. And a lot of the insurers have local underwriters, which means they get access to that information. So it can be a really useful source, especially if you're trying to kind of avoid any bad debts within 2021 and beyond. And then the last piece really for me is around the re-emergence of zombie firms. So anybody that's seen anything that I've kind of put on LinkedIn over the last couple of years, you'll know that it's I guess a hot topic for me. I felt that back in 2019, before the pandemic, that as an economy we were kind of seeing a regrowth in that kind of zombie firm base. 2020 then hit, and because of the government stimulus schemes that were there, certainly within the UK, but I know it's comparable across the globe, those stimulus schemes enabled these zombie firms to continue to go and continue to live on. So that is something that people need to be wary of when the stimulus schemes end, that certainly tougher economic climates don't end up with those things coming back to bite. And therefore, for me, in terms of opportunities, I still think that 2021 and 2022 are going to be, there are going to be plenty of winners in terms of growth as businesses. But the importance and the value of information for me is never really been higher. And being able to access that, whether that's via information carriers, DB gradings, whoever, then it's any source you can use, I think, is the key. And that's. And obviously, I'm going to say it's about credit insurance because of who I work for, but it's information is really king.
Okay,
thanks, Henry.
That's fantastic, Ian. Thanks very much for that. That was brilliant. Adrian, with these challenges in mind, can I ask you to jump in now with your view? What are the things going to be like when the special COVID restrictions and court insolvencies are relaxed? What are they going to mean? Could you give us an update on that, or an overview, please?
Yes, Henry, thanks. I think it's interesting to hear people talking about the different regions and the stimulus packages, and also Ian there talking about the re-emergence of the zombie companies. And one of the most interesting things is going to be as we come out of COVID, because it's not just the stimulus packages that have held things together, but it's the way governments have put the brakes on the insolvency process. So the things probably look a little bit more even than they are. And there is, I think, for me, the biggest unknown is what's going to happen when you take the brakes off. And you can see that by looking at, I just look at a couple of comparables at the moment. So Russia, in their COVID insolvency proceeding restrictions, were very creditor friendly. So if you could demonstrate that a bankruptcy or an insolvency was down to pre-existing or non-COVID related issues, you could still proceed. They actually brought their moratorium on proceedings to an end in January, 7th of January, things were returned more to normality, and they brought in procedures whereby you could actually issue a claim to overturn an antecedent transaction that took place during the COVID moratorium without bringing insolvency proceedings. So actually, how that compares to on the other end of the scale, Kazakhstan, where they put in a very tough moratorium. There was a moratorium on bankruptcy filings and many other support packages. The moratorium on bankruptcy filings will continue until the 1st of July this year, which is the same time as occupants of state-owned property will start to pay rent again. You've also got there the SME company exemption to pay property tax and employment tax till the end of the year. So, you know, it's really interesting. That's a reflection of the fact that Kazakhstan was hit particularly hard economically in the period. Looking at some of the others, Czechia, as I now understand it's to be called, the key date there is the 30th of June this year. That's the hard stop date for the end to the special restrictions. And I think the point that everybody's made throughout this is the value of information has never been higher. And there are two bits of information that are going to be critically important. And that is what the dates are, when the shutters go back up again in the insolvency courts and proceedings more generally, but also what the transitional position is and what arrangements they're going to make. I mean, it's been interesting seeing the UK, the way the insolvency courts have just shut down, and the speed with which they are going to be able to get back up and running at full steam looks quite challenging at the moment. The indications we've seen so far are that the increase is going to be very slow. That's one point. And in the summary notes, I've also looked at Poland and Ukraine again, which are at different ends of the spectrum of flexibility and creditor friendliness. The other thing that's quite interesting is looking at the insolvency statistics for 2019 versus 2020. Poland, for instance, had a significant increase in the number of restructurings. They went up almost 50% from 19 to 20. That may be a reflection of the fact that the government brought in, rather than putting the brakes on everything, they brought in a much more simple moratorium process where you didn't need an absolute majority of your creditors, and there was a much less information needed in order to get the moratorium. Most other places saw approximately 20 to 25% reduction in corporate and personal bankruptcy. Czechia, for instance, insolvency proceedings, 2019, there were 1,000, 2020, 750. Russia, over 12,000 in 2019, just over 10,000 in 2020. So it is going to be interesting to see. You've got to think that some of the reduction are going to be companies that have converted into zombies to get through this because of the moratoriums, the restrictions, and the stimulus packages. But when the brakes are taken off and that isn't available anymore, it's going to be quite a tough time. But when that actually hits, is going to be different in different areas. Henry.
Sorry about that. Thanks a lot, Adrian. That was great. So everyone, just another reminder, please do send your questions to me for the panel, as we're getting close to running out of time now. So we're going to try and do some of those at the end. But before we do that, we'd like to take a brief look at possible risk mitigation strategies and to respond to some of the challenges that we've talked about today. So if it's possible, we'd like to hand it over to Lisa to see the core strategies that she might be looking to implement. So are you there, Lisa?
I am indeed. Thank you, Henry.
Let me just get your screen up. Hold on.
I know I don't have too long now, but what I wanted to really look at was what are the key challenges for credit management in trading with Eastern Europe. And in fact, I'm quite pleased that we picked Eastern Europe as the first territory for us to look at, because I think for many years, Eastern Europe has been somewhat of a Pandora's box for credit management. And I say that because since the early 1990s, when large multinationals started investing in Eastern Europe, indeed setting up their own shared service centres there, moving there logistically, it created a lot of opportunity for business and trade. But also with Eastern Europe, it comes with its challenges, as we know. It's certainly different to I'd say, Western Europe. Sorry, can you just put my next slide on, please, Henry? Bear with me. So when we look at Eastern Europe, it is, of course, a very large geographical area. And I think, one thing we can never do within credit management is be stereotypical. But one thing we can look to do is maybe bring it down into, or define it by territories which are in the EU and ones which are not, because they do differ greatly. I think, of course, our credit policy should reflect that. We definitely have more security and confidence in trading with countries that are in the EU, only because it gives us some commonality in trading, and there are some forms of standardization. So, for example, we have the comfort of the EU directive for debt collection, cross-border enforcement, and to all extent and purposes, common currency as well. So I think probably the more established economies are easier to trade with for credit management. I know we've touched a lot on Poland today, probably also Hungary and Czech Republic and Romania, some of the more established economies. But I think the challenge now for credit management, particularly post-COVID, is to look at more challenging territories and maybe look to encourage trade in other regions and support sales and growth. We certainly know, as economies develop, so will trade. And of course, the challenge then is for credit management to respond and define a trading policy. So I've stripped it back really into what I think are the three most challenging areas for credit management in trading with Eastern Europe. I know we've touched a lot today on the lack of financial information and performance visibility, but we also have to consider UBO, and depending on the kind of industry that you're in also, and the services that you provide, possibly sanctions and corruption as well. And then the third issue I think is quite important is to look at currency issues and political risk, particularly when we're looking at territories outside the EU, possibly some of the old Soviet Union areas. So if we look at our first issue, which is definitely the lack of financial information, I think I've worked with credit managers now for about 20 years. And I know with Eastern Europe, this is the biggest challenge for them. It's literally getting hold of financial information so that they can make a fair assessment and have some form of surety. So I think the key question is, if you don't have financial information to make a credit decision, what can you use? What other sources are there? And I think there is actually some good news. In the countries where we don't even have, say, the equivalent to our Companies House, so for example, they don't even have their own registries, and where they do, the filing laws are very relaxed, of course, that challenges the credit reference bureaus then, because they can't, or they find it hard to put together enough information to give you a credit report. The one constant we have, though, is the banking institutions, because the banking will always be motivated and encouraged for commerce, to encourage growth. They want their customers to get trade with companies outside their local country. And what we're seeing now is a big growth in the use of open banking, and the banking institutions actually encouraging access to financial information. So if you can't get a credit report, what they're saying is, look, we'll give you access to a company's financial performance and their banking. I think a good example of this is the Baltic region. And a company that I would recommend you look at if you're trading in some trickier territories where there's very little information is a company called Credit Info. So their website address is www.creditinfo.com. And what they're doing as a company, I'd say they're not our traditional credit reference bureau, but they look to move into countries where there is very little information and create it. And they're very much working with open banking at the moment. Another area that you can look at to obtain information where it's poor is maybe look at forensic reporting and specialized investigations. So this is becoming more and more popular now. So traditionally, big banks and financial institutions, they've always used forensic reporting, but it is becoming more commonplace for businesses to use it. So some companies that you could look at to obtain this information would be your big, or the top three, if you like, so PwC, Deloitte, Ernst Young, but there are also some dedicated smaller companies that can provide forensic reporting. And all of this information, by the way, we're going to provide in the follow-up executive report. I'd say the third thing that credit management can do, if you're finding it hard to get hold of information, is consider the fact that, over the past 20 years, we've developed very much in technology and software. So many of your prospects or clients in these difficult regions will be using some form of cloud-based software package. Now, it might be a difficult or a challenging thing to ask access to that, but some companies find it challenging to ask for a director's guarantee. So you might want to consider asking them, what software do you use in your AR, in your collections, in your AP, and ask for some kind of access or extract from that, just to give you some visibility. So I think the second challenge that the companies have in trading with Eastern Europe is probably ultimate beneficial ownership, sanctions and corruption. I think it's very much the elephant in the room, but it is a given that in some countries we still have the issue of government corruption and corporate bribery, and it's more prevalent in these regions, particularly when we start looking at some of the countries in the older Soviet Union and the non-EU countries. The issue that we have, if you can get hold of a credit report, is that you'll often have an assumed name, and it's very difficult to understand who the true owner of these companies are. So you actually have to run a deeper analysis. And what I would recommend doing is looking very much at a company's group structure or corporate family tree. And a good point, actually, whoever you're working with in your data sources, whatever credit reference bureau you work with, ask them what percentage do they report on in the shareholder company information. Because I know that some credit reference bureaus only go down as far as 25% on their linkages. And when you're trading in countries where, sanctions, corruption is an important issue to look at, it really is important to know who is the actual owner of this company. I think another point with the issues around UBO is it's very much having a more robust and enhanced client onboarding process. There's probably going to be, there is going to be an increased cost to sale when you're trading in these regions, but you can always look to obviously absorb that in the cost with a sales team. Another thing you can do, if you're in doubt in trading with some companies in difficult territories, or if there's hesitation in who the true owner is, as an idea, you can always go back and ask them for company formation documents. And obviously run a lot of details, social media searches. But again, the one constant we have in credibility is definitely the banking institutions, because they're so very heavily regulated, and it's difficult for the government can't manipulate them in any way. So definitely look at obtaining bank references. And the third issue, or third topic, or challenge I think credit management has, is definitely looking towards currency issues and political risk. I think it's becoming more prevalent now that companies are having their terms and conditions and contracts that are subject to local law, not just in Eastern Europe, but in all territories, particularly in regions where it's difficult, you know, to enforce a debt if it's subject to UK law or US law, and you trade in some European countries. But that's definitely something as a given that you should have, that ensure you look at local legislation and that your terms and conditions adhere to that. Another thing to look at around currency issues, and I think we can use LATAM regions as a good example of this actually, is when there's restrictions in country around currency movement. Sometimes it's difficult to actually get currency out of the country. So your client might have the money to pay, but they literally can't get it out. I think something to consider in your, your terms and conditions is to say, okay, well, who absorbs that cost? You know, who does that fall down to? That's certainly something to look at. And again, when we're looking at currency issues and political risk, maybe consider your route to market. So if you're trading in more difficult territories, think to yourself, well, is it easier if we go end retail, if we sell direct to clients and we spread our risk? Or is it a safer bet to look at a business model where you trade more through wholesalers and distributors as opposed to end retail? Yes, you're amalgamating your risk, but it's much easier to manage. It's much easier to monitor. And there's a lot of new like fintech finance companies now that could even look to provide some form of invoice discounting on that risk. Well, definitely when it comes to insurance, obviously we can speak to Ian. But they are the three issues I would say are prevalent when we look at currency issues and political risk. And that's me. Thank you, Henry.
Thanks a lot, Lisa. That was a good overview on what you covered off there.
I tried
sorry.
I tried to be quick. I did narrow it down.
That's fine. That's fine. Thanks for we've run over slightly. So what I'm going to have to do is wrap this up. We've had a few questions come in via the chat, which we'll come back to people on individually. But thank you very much for taking the time to send those questions in. If you wanted to ask any further questions, you've got my email on the invites that were sent out. The email again is henry@bakering.global. And also, just before we go, it's worth reminding everyone, if you haven't already, please go to hostedbyhenry.global and register. So this will ensure that you receive all of the global outlook reports for the session, as well as future reports, webinar invites, fact sheets and white papers. The next webinar will be covering LATAM region. This is going to be scheduled for June. So again, if you register, you'll get information on that. That should be sent out in the next week or so. So once again, thanks to the panel. Thanks for the people that submitted all the information to cover everything. We hope you found the webinar informative, and we look forward to seeing you again in June. So thanks a lot, everyone. Thank you.
Thank you.
Cheers, Henry.
Thank you.
Thanks, Henry.
You.
Bye. Cheers.